Hey everybody, we're back with another portfolio management edition of this series. This time we're back with Bush Sherman's, looking at Bush's asset location. Now we all know what asset allocation is. That's a widely known topic for investors. In other words, your mix of stocks, bonds, and other assets. This is something a little different, which not a lot of people know about, and if they know about it, they're not implementing it correctly. This directly relates to the tax efficiency of one's portfolio. So let's say I'm a 50-50 investor. I have 50% stocks and 50% bonds. That would be easy to implement if I owned one account or had one type of account, like an IRA or a taxable account. Oftentimes we see people that are 50-50 investors, but they have three different account types, and I've outlined those here. So on my screen, you'll see a taxable account. So this is monies you've already paid taxes on. You went ahead and invested. You can see the amount is roughly $500,000. I have a tax deferred account. This would be your 401k, your IRA. Again, that's $500,000. And then the tax-free account, which would be like a Roth IRA. So the money's paid taxes on them, they're invested, they grow tax-free, you take them out tax-free. Three different account types: taxable, traditional IRA, Roth IRA. So my total portfolio value here for Bush is 1.5 million. A quick mental shortcut would say, okay, 1.5 million, I'm gonna invest every account the same, and I'm gonna have roughly 750,000 in stock and 750,000 in bonds. That would be a mistake. Yet that is how many advisors, many investors build their portfolios. Today, we're going to talk about how you can optimize your portfolios for asset location, where you own certain asset classes, and boost your net after-tax returns. The best part about this is you can have zero opinion about what the market does next. This has nothing to do with forecasting or having some hot view on what asset does what next. It's a low-hanging fruit that you can take, you can harvest, and it'll give you a better opportunity for a favorable outcome. What's not fun about saving money on taxes? So again, we've got our three different account types: Bush's IRA, his Roth, his taxable. Okay, so let's go ahead and optimize this for taxes. Now again, once we're done with this exercise, we'll still be a 50-50 investor, right? So nothing is changing about our allocation to boost our net after-tax returns. Again, where we own certain types of asset classes is going to change. So this software actually assigns a tax score to our portfolio. So here's our current tax score, and the higher the tax score, the better. So 65 is our current, not fatal, but not optimal. And our current after-tax return is 5.45%. So we have a pre-tax return, and then we have an after-tax return. This after-tax return is what you should pay attention to. And assuming this rate of return of 5.45% over 20 years, or 1.5 million, grows to roughly 4.3 million, you might say, hey, that's great. That is great. We've done a great job of saving, investing, and compounding. We haven't interrupted our compounding. So we've allowed that portfolio to grow over 20 years. Is it optimal? No. Could we have done better? Yes. So just by changing where we own certain asset classes, you can see this is the current, this is the proposed. We can boost our tax score to 100, and again, higher is better. And you can see instead of 5.45%, we're getting 5.64%. You might say, hey, Nick, that's not a big deal. That's only roughly 0.2% better. And that's true. But that 0.2% boost is compounded over 20 years. And as these dollar amounts get bigger, we're talking some substantial money saving, tax saving. So just by doing this, just by boosting our after-tax return by 0.2%, we realize a benefit of 160,000 over the course of this 20-year period. That's not too bad with minimal work. So how do we get there? Okay, now this example is pretty simplistic, right? But I think it does a good job of driving our point home. Again, this is our pre-tax return, 5.77. Our current portfolio after we pay taxes, so we have some tax drag here, 5.45%. Okay, that's our current. Our proposed, we're getting actually a little bit lower pre-tax return, which is fine because our after-tax return is better, okay? And a lot of these numbers, like in theory, this should be the same as this, But what the software does, it applies a different return expectation for various types of bonds and various types of equities. The most important thing is this after-tax return. So how do we get there? How do we get from tax drag to tax efficiency? Well, again, it's asset location. So in our taxable account, where the current mix is 50% taxable bonds, 50% active mutual funds or active equity strategy. They're proposed. We're going to blow out, we're going to sell all of our taxable bonds. We're going to sell all of our active equity strategies, and we're going to go 100% muni bonds. So 100% tax-free bonds. And we're assuming, in this case, Bush's federal tax rate is 30%. And his capital gains rate is 15%. So again, blowing out of the taxable bonds and blowing out of our equities in our taxable account and reinvesting the proceeds 100% in muni bonds, tax-free bonds. So the income to us, tax exempt from federal. If you live in a income tax state like Oregon, let's say, maybe we layer in some Oregon bonds that will be tax exempt from Oregon income tax as well. Looking at our IRA, which could be a 401k, no changes here. So we're going to stick to our 50-50 split in corporate bonds or taxable bonds. Could be high yield bonds or treasuries in here. And then we're also going to stick with our current equity strategy. So no change here, 50-50. And our tax-free, so our Roth account, we're getting rid of all of our bonds. We're investing 100% in equity. And I want you to ignore the equity passive and the equity active. So ignore this distinguishing passive active thing. That does not matter. What matters is selling bonds and adding 100% to equities. So as you can see, our 50-50 investor is still 50-50. The biggest change is coming from getting rid of all of the taxable bonds and the equities in our taxable account and moving to 100% equities in our Roth account. Now, why would you move to 100% equities in your Roth account? Well, quite simply, you'll never pay taxes on that money again. So you want assets that move and move hopefully higher. It is an error to own safe assets in your Roth IRA in general. You know, if that's your only pot of money, let's say you have 100% of your net worth in your Roth IRA, that would be the exception. But here you can see we have 3 different pots of money or 3 different account types. So we're going to own 100% equities in our Roth account because we'll never pay taxes on that again in 20 years. You know, achieving a modest rate of return or historical rate of return for equities would see that account grow quite nicely. And that's a huge tax benefit. Bush took that $500,000 and turned it into $1 million over 20 years. He'd have $1 million in tax-free income, which is a nice place to be. So this is it. This is asset location. It's very basic, but again, it's probably one of the biggest things our prospective clients get wrong. And, you know, again, one of the things that we do for folks is just look at the low-hanging fruit, and we look to harvest the low-hanging fruit because there's a lot of things when you're talking about investing that we cannot control. And a lot of folks are externally focused, and that's fine. You could be focused on inflation, the Fed, what stocks to buy. That's great, but it's really difficult for us when we see someone externally focused and they're not taking care of the things they can control. So this is something with a 30 minutes to an hour of time, you can go through and optimize your asset allocation and asset location to boost your after-tax returns. Thanks for tuning in. We will see you next time, and we'll get into what types of assets are the biggest tax offenders. So let's say you own certain types of assets in these taxable accounts. We can share with you tax killers. So assets that saddle investors with a tax liability at the end of the year, and oftentimes they don't have to do anything and they don't really know what's happening. So look for that next time. Thanks for tuning in.